and sifting through the real estate wreckage to find some real opportunities. Real estate asset manager Philip Blumberg of Blumberg Partners will give us his perspective. Plus, we'll also talk to one of the biggest commercial real estate operators in L.A. Squawk Box will be right back. Well, let's talk about the commercial real estate property values. They've been sinking across the nation as foreclosures continue to rise. But our next guest sees some opportunity through all the chaos. Joining us right now is Robert McGuire. He's the chairman and chief executive of McGuire Investments, also one of the biggest commercial property owners in L.A., and Philip Blumberg, who is the chairman and chief executive of Blumberg Partners. That's a real estate asset management company. Also, our guest host today, of course, Jeff Green. Gentlemen, thank you for joining us. I want to start things off with you, Philip. Where do you think we stand right now, just in terms of commercial real estate? We know it's a problem. We know things are getting bad. But is it better or worse than when you read in the media all these headlines?
I think it's going to be getting significantly worse.
You do.
Every job layoff, it pegs to our commercial real estate market. It's a contraction in the tenant base. But the real story here isn't the performance of the market, it is the debt. Think about this. We got about $300 billion in the next 3 years, 2010, which is when it really starts, to 2013. We got about $300 billion in CMBS, of which 70 to 100 billion is not refinanceable. Okay, but to put it in real perspective, on top of that, there's $1 trillion of bank loans written in the same time frame with the same dubious underwriting coming due in that period. $1 trillion in bank loans. So I think when you talk about the banking sector, we're talking about a major impact, another blow to the belly of the banking sector when commercial real estate really hits. We haven't seen we've just seen the tip of the iceberg thus far. 2010, 2013, it really hits.
Rob, you say the same thing. It's not just the slowing economy, but it's this reckless over-leveraging, in your words on this, that has gotten us into this trouble. Are there still opportunities out there, though?
Yeah, I think there are very significant opportunities. I think what we're seeing is there's so much money starting to come into the market with $9 billion of new REIT equity offerings, and Simon Properties just did $500 million of new debt, I think yesterday, at 7% for 5 years. So those are encouraging things. We clearly have not disappeared into the Bermuda Triangle, so the black hole's been avoided, but it's going to be a long period. I think the TALF program is going to be very valuable, both to set a basis on values and provide financing roughly up to 85% of about 50% of value. So I think that's going to create very significant opportunities for lenders if they can get it moving in June.
I'm sorry, if they can get a move?
But if they can get it moving in June, I think the program really looks like it can work.
Okay.
And so it's going to be a long period of time. I think there are going to be. I think the buying opportunity for trophy properties is going to be unparalleled. I don't think we've seen anything like it in the last 15 years. The
caveat being that you just have to have cash, or at least really good credit and access to some bank that will lend you the money.
Yeah, absolutely. Well, the banks aren't lending money, the insurance companies aren't lending money, so the financing market really stinks. But with TALF, and I think it'll start rebuilding, but it's going to be a period of time.
Jeff, what are you doing right now? I know you've got a huge amount of properties, apartment buildings, and other things that you own. What are you doing right now as a way to either take care of those properties? Are you extending into other areas?
Well, I mean, I'm very pessimistic about the economy and about the look at today, 637,000 new jobless claims, 6.5 million people with jobless claims. I mean, we're in a difficult time. You talk about the REITs as an example. I mean, to me, they look like even though they've raised $9 billion, to me, it's like a slow-speed train wreck. I mean, you've got these REITs that own commercial buildings are dealing with several things. First of all, they've got leases that come up. They have to renew them. Sometimes, if it's an office building or retail, for multiple years at highly reduced rents. On top of that, the financing that they have at 4%, 5% is being renewed, not being renewed at all. If they're lucky to be renewed, it's being renewed at 8 or 9%. Then on top of that, if you look at the REITs, look at the equity dilution that's happening. So to me, it's a triple whammy for them. What I'm personally doing is just trying to manage our portfolio of real estate as defensively as possible.
So not making new incursions.
No, I don't see any signs that the economy is doing better. You look at the statistics. We could have 5 years, 7 years of slow growth. So I'm on the sidelines for quite some time, and I haven't really seen any distressed offerings yet. There's still a huge disconnect between what sellers
Yeah.
are asking for properties and what buyers are willing to pay. So there are no deals yet but there will be deals. But I think what will happen is by the time the deals come along, everyone will be so beat up they won't want to buy them anymore.
Philip, is that, I see you nodding your head at that.
Yeah, we're looking at, my company's going to be participating in 3 areas. We sold our entire inventory by June. A year and a half we had a selling program going on because anybody in real estate who wasn't motivated by fees understood credit was locking up. And if credit was locking up, prices were dropping. So we exited. We made 17.6% positive last year when the rest of the industry is turning negative. Based on, and we have no debt. So we got a good war chest. What we're looking at is 3 areas. And I would agree with Jeffrey, you know, if you're talking about bricks and mortar, you better stay on the sidelines for now. There may be one-off deals, but the central process of buying trophy assets or large assets is going to wait a little bit. Right now we're looking at CMBS. We're looking at loans under the TALF program that Rob mentioned. We're looking at buying distressed debt. We have a lot of investors who are interested in us doing that. The second area, REITs. Commercial REITs are going to be suffering. They are not well structured to go through a distressed time. We're looking at buying REIT securities and possibly whole REITs. And then third, and a little bit later, we'll begin the bricks and mortar business again.